Is it time to sell Chinese stocks? By www.profitableinvestingtips.com. As Chinese stocks fall, the question is if Chinese stocks are heading still lower. The Wall Street Journal reports on the turnaround of Shanghai Composite stock index. After rocketing up last year to rank among the world's top performers, China's stock market has turned into a global laggard. The Shanghai Composite has lost 7.2% since January 26 and is down 2.9% for the year, making it Asia's biggest loser. Among the world's larger markets, only Venezuela has fallen more, with a decline of more than 9% as of Monday. The market's malaise results from a trio of factors: a deteriorating Chinese economy, concern that too much borrowed money has flooded into the market, and a flurry of share sales that is sucking up cash. Investors sold their real estate investment properties last year as the Chinese real estate bubble began to collapse. It is the flood of new stock market investors who drove up prices 50% in the latter half of 2014. Now, many have decided that it is time to sell Chinese stocks, and the Chinese market is heading south. As the Shanghai market weakens, what has been happening to Chinese stocks listed as American Depository Receipts? Chinese ADRs. We picked China Eastern Airlines Corp., CEA, on the New York Stock Exchange to see how a Chinese ADR did during the run-up of the Shanghai market. In July, when the Shanghai market began its run-up, the CEA ADR sold for $15.41 a share. It peaked at $26.32 a share on January 15th of 2015, and has fallen as low as $22.98 a share in the last few days. China Eastern Airlines Corporation Limited is an air carrier operator in China. The company provides civil aviation services, including passenger transportation, cargo transportation, and mail delivery services. The company signed a purchase order for 80 Boeing B-737 jets in July of 2014 and is in expansion mode. The question is if expansion will continue as the Chinese economy falters. Is it time to sell Chinese stocks? What we should be watching is the overall state of the Chinese economy. The next great risk. Japan has fought deflation for nearly a quarter of a century, and aggressive austerity measures are threatening recession and deflation in Europe. The Financial Post believes that China is the next great risk for a deflationary world. China is trapped. The communist authorities have discovered, like the Japanese in the early 1990s and the U.S. in the interwar years, that they cannot deflate a credit bubble safely. A year of tight money from the People's Bank and a $250 billion crackdown on shadow banking have together pushed the Chinese economy close to a debt deflation crisis. The surprise cut in the reserve requirement ratio, the main policy tool, comes in the nick of time. Factory gate deflation has reached 3.3%. The official gauge of manufacturing fell below the boom-bust line to 49.8 in January. Is it time to sell Chinese stocks? Anyone who has made money in the last months and years in Chinese stocks probably wants to take a little money off the table, so to speak. The old saying is that you do not have a profit until you take a profit. And as the Chinese economic growth miracle starts to look like it is in for a big reset, many may simply choose to sell out entirely and hold cash, which is the best asset to have during deflationary times. For more insights and useful information about investments and investing, visit www.profitableinvestingtips.com.